Are you serious about how to grow your wealth in Singapore safely and smartly? Whether you are just starting out or looking to diversify, there are plenty of investment options in Singapore for retail investors, from the cautious saver to the confident risk taker. Best of all, these investments are regulated by MAS and backed by government-approved frameworks. Today, we will explore 4 popular investment tools in Singapore for 2025: Singapore Saving Bonds, Retail Bonds, REITs, and Unit Trusts. If you want to know how to invest safely and grow your money in Singapore, keep watching as we break down each option and what you need to know. Let's start with the safer and most beginner-friendly option, Singapore Saving Bonds, SSB. Think of SSB as Singapore's sleep well at night investment, fully backed by the Singapore government. So your capital is safe, returns are stable, predictable, and increase the longer you hold them, up to 10 years. And the best part, you can redeem anytime without penalty, making SSB a flexible, a low-risk investment in Singapore 2025. Many Singaporeans often higher than bank rates. Big names like Temasek Holding and CapitaLand have issued retail bonds that everyday investors set up quickly. The catch? Since repayment depends on the company's financial health, that's slightly more risk than SSBs. But for investors who want regular income and are comfortable with moderate risk, retail bonds can be a rewarding option. You can apply via internet banking or ATMs of major banks in Singapore. Minimum investment is usually $1,000 per lot, with multipliers of $1,000 thereafter. Interest is paid semi-annually directly into your bank account. Retail bonds have fixed tenure, typically ranging from 3 to 10 years, depending on the issuer. Retail investors looking for regular income rather than high-risk growth. Those who want to step up from the ultra-safe SSBs but don't want to manage stocks actively. Beginners or seasonal investors who want diversification in the low to moderate risk bracket. Higher returns than SSBs or fixed deposits, predictable semi-annual interest payments, accessible to everyday Singaporeans with a low entry point compared to wholesale bonds, MAS regulated and transparent, providing peace of mind. Slightly higher risk than SSBs, longer commitment, not suitable if you need high liquidity, although some bonds may be tradable on the Singapore Exchange. Check interest rates and tenure carefully to ensure they match your investment goals. Now let's move into something that excites many Singaporeans, REITs, or Real Estate Investment Trusts. We all know property is big in Singapore, but buying a condo or commercial building requires massive capital. With REITs, you can invest in income-generating properties, from malls and offices to hospitals and logistic facilities, without owning the building yourself. REITs are listed on the Singapore Exchange, so you can buy and sell them like stocks, giving you liquidity and flexibility. Open a CDP account and a trading account with any local broker or bank. Minimum investment is the price of one unit, often under $1,000 for retail investors. Many REITs pay out dividends quarterly, giving you a steady income stream. You can track prices, dividend yields, and market performance easily on SGX and financial portals. Retail investors looking for passive income, those who want property exposure without massive capital or management responsibilities. Investors seeking portfolio diversification beyond bonds and stocks. Suitable for both beginners and experienced investors interested in long-term wealth growth. Regular dividend income, access to commercial properties with relatively small capital, tradable on SGX, providing liquidity unlike physical property. Portfolio diversification beyond bonds and equities, often backed by established property developers or trusts, adding credibility. Market risk. Property value and rental income can fluctuate. Interest rate sensitivity. Rising rates may affect REITs prices and dividends. Dividend is not guaranteed, it depends on property performance. Management fee may apply, reducing overall returns. provided real-world property exposure for a small investment, popular with retirees and passive income seekers because of predictable cash flow. Some REITs invest in prime Singapore or overseas properties, giving investors access they couldn't afford otherwise. While dividends are attractive, REITs carry more risk than government-backed bonds. Investors must monitor market trends, interest rates, and property occupancy to protect returns. Returns are linked to property performance, so true research is essential. Finally, let's talk about unit trusts. Imagine you want to invest in a mix of stocks, bonds, or even global markets, but you don't have the time or expertise to pick and manage everything yourself. That's where unit trust comes in. You pool your money together with other investors and a professional fund manager invests on your behalf. The advantage: instant diversification and expert management. Unit trusts are flexible too. You can find funds tailored to your risk appetite, whether conservative, balanced, or aggressive. The trade-off is that they often come with management fees, but for investors who prefer a hands-off approach, they provide an easy gateway into broader markets.